We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Tavi Costa, Portfolio Manager at Crescat Capital. How are you today, Tavi?
Great, Tom. Thanks for having me again.
Excellent to have you back. You always provide us with a real great macro overview and some really great pieces of information as well on the mining side and stuff. So I'd like to start today by talking about the main pillars of inflation that you think about. So what are these pillars that need to be taken into account, and what are the outcomes of all of them together pointing to?
Well, there's a lot of unpack on that side. I think that the first one has to do with the transfer of wealth, which a lot of people have a real hard time, wrapping their arms around this because it doesn't sound right. It sounds like the government has not been taking care of the bottom 50% at all. But the truth is we're seeing more policies directed towards that, especially the fiscal agenda. When you look at the main fronts of that, one of them is what I call the peak inequality issue, which I think it's in a way is mostly driven by the current administration. But I think it's happening in a large way. We saw food stamps increasing 27%, largest increase in history. That is not what's going to drive demand, obviously. But there are policies such as the cancellation of debt, students' debt. Those are all forms of transfer of wealth. And the other one is the helicopter money policies we've seen so far since COVID started, especially, which are very much directed to the bottom 50%. So when you look at numbers of just the growth in net worth of those individuals, and some folks have said, well, but that's financial assets. Not really. The bottom 50% has been increasing like never before. And the majority of what they own is really in housing. So housing has been increasing in value and so forth. And so that has had a large impact in net worth of individuals as a whole. So that will be one of the things that could perhaps drive demand. Obviously, we've had a lot of inflation that will have issues and cause issues to the increase in net worth. But that's just one pillar. That's just one side of the picture. The savings rate is another part of that. We've seen a very large amount of savings. That is just cash on the sidelines. And people unfortunately get confused with that by thinking I'm talking about a roaring 20s, and that's nothing to do with that. The second thing has to do with the logistics and the issues that we saw after the 1919 Spanish flu, which were very similar to what we're seeing today in regards to, well, first of all, raw materials became sort of a rare thing to find. And that was one of the reasons why a lot of we've had not only supply issues, but the price of goods and services began to rise significantly. That created a rise of cost of living, and workers began to really demand higher wages and salaries. We saw 1 out of 5 workers in the labor force were engaged in a protest, in a labor protest. And so it was very normal to see that sort of demand to increase remuneration of those folks. And then I would say that one of the main reasons why we have not seen inflation, we've seen some cyclical moves on the upside for inflationary forces, but all of those were immediately turned lower given the fact that we have other deflationary forces in the system. And one of them is this long-term or secular decline in growth of wages and salaries. And I think that's about to change. There's a lot of ways you can see that, and a lot of people are paying attention to some indices that the Federal Reserve creates that only survey about 60,000 households. I mean, what is 60,000 on amount of the labor force here in the U.S.? It's less than 1%. And so I think that those are the wrong ways to be looking at wages and salaries. If you just take the personal income number and break down the wages and salaries and divide that by the number of employee people, that's the way to do it. And you can see that that's growing at about, I believe it's at about 14% year on a 24-month change. Why did I do 24? Because anything annual change has been wacky given the fact that we saw what COVID did. So just to smooth out the volatility and see the large trend, you can clearly see that we are perhaps breaking this downward trend. And I think we're going to get into a secular increase in wages and salaries, as you can see, job openings surging, at a time when, we're not seeing the labor market follow the same way. Clearly, there is a need for folks to be that wanted to get paid in a higher levels than they have been in the past. And so I think this is all, a very structural change here in regards to the inflationary pillars that we find. The third one has to do with the most important part, which is the fiscal and monetary disorder, where monetary authorities have been using their tools in order to suppress interest rates and reduce the cost of debt in general worldwide. And we're seeing that in a way where the monetary dilution has really increased the size of central bank assets in a way we haven't seen before. And I think that's all wrapping up into a way where a lot of folks have been looking for tangible assets to buy, some of them like different types of commodities, some others like housing. But we're seeing a rush towards anything that is tangible. And so, sure, we had a pullback in commodities recently, but it's a very different market than we saw 10 years ago, where not only was really financial assets that continue to go higher, and they continue to go higher still, but I think the leadership has changed dramatically in the last year or so. And so I think we're going to continue to see that going forward. And in my opinion, there's even a fourth pillar of inflation developing more in the long term, which has to do with China. And that is also in the very front of the fiscal agenda, where we saw initially Trump, I think, was the one who really started this sort of deglobalization move, arguably. And the way he was dealing with this was one of the options, which was using tariffs to have tariffs on imported products from China. The issue with this is that, well, now the Biden administration is taking a completely different approach. What they're doing here is looking into increasing fiscal stimulus to create subsidies for domestic companies in the U.S. and allow them to really compete with domestic companies in China. And so this is not only happening in the U.S., we're seeing some other parts of Germany. And so that's going to create a need for further fiscal stimulus going forward. And we're going to need lower cost of capital going forward, too. So there is when you look at the constraints of monetary authorities and policymakers, the constraints are on the cost of capital side, given the large amounts of debt that we have in the system, but also is on the valuation of assets. And so it's forcing them to continue to pursue those policies that are very inflationary on the long term. And that's what creates this all these pillars of inflation that we're seeing. Usually policymakers need a strong reason to spend money. And I think they have plenty today. They got the Green Revolution going. They have this fiscal arms race with China. They have this peak inequality problem. And so all those things are in the infrastructure revamp that we're seeing so far, that, I think this is bipartisan. So there's a lot of reasons for policymakers to spend money. And I think that the monetary stimulus as a whole will be, different than a lot of people see as a focus on, maximum employment and inflation and stability. I think it's going to be focused on suppressing rates going forward. So just to wrap up, those are the four pillars of inflation. Three of them are moving all along today. The one with China, I think it's a long-term one, as we see, countries coming out of China as a manufacturing plant of the world. I think that's moving. A lot of countries have been moving away from that with automation, 3D printing, and so forth. Obviously, that's going to take a long time to play out. But all of those are one way to see how deglobalization may be entering here in the system in a way that I think it's largely inflationary, at least at the very beginning of it.
So, Tavi, you mentioned the cost of capital right now. And your pin tweet on your Twitter profile talks about how the Fed is trapped. So have these policies of targeting this 2% inflation rate painted them into a corner from which they can't escape?
I think it did, and when I talk about cost of capital, there's a lot of ways of measuring that. One of them is the embedded cost, which has to do with it's kind of a hidden cost, really. Well, where it comes down to the inflationary forces and how much you have to return above inflation in order to justify the cost of borrowing money or issuing money as a whole, or issuing shares of a company. And I think has been increasing with inflationary forces rising. There's also the cost of interest rates rising too, where I think that we've seen some of that this year with 10-year yields and long-term rates rising a bit compared to other years. And there is a very interesting chart, Tom, that I like to look at, which is the percentage of ownership of the Federal Reserve in treasuries. And when you look at that and invert relative to 10-year yields, you can see that there's a clear relationship between the two. The correlation is actually pretty tight throughout history. And so that gives you a sense that perhaps if they start tapering, that would create some at least some upward pressure on cost of capital as a whole. And so I'm a little worried of how, that's why I say, so what should they do? I mean, I think they're trapped. I mean, I really do. I think if they start tapering and try to normalize their policies, we're going to see a major issues, not only with the reckoning of the valuations problem that we have in equity markets and corporate bond markets and even treasuries as a whole, housing market. I mean, everything is expensive and needs the suppression of rates in order to justify those valuations. And so I truly believe they're trapped right now. And the other way around this is to continue to do those policies that they have been doing over the years. And what prevents them to do that? Well, what prevents them to do that at some point is inflation. And they've been hiding what the real inflation is in the system. I mean, there's so many ways we can see this. I mean, I was just looking at yesterday, the cost of Uber and Lyft rides, which I think it's actually much higher increase here in Denver. But Yahoo Finance had some research saying it's been increasing since January of 2018 by about 90+%. So almost double since January 2018. Well, you look at the actual number that is reported on the CPI, which is intra-city transportation, which includes cabs, taxi fares, and Uber and Lyft. That is now included in that as well. You can see clearly that the increase is only 5%. So, what's the how in the world are they getting this so wrong in so many different indices and components of the CPI? Well, the reason is I think they've never seen this level of increasing inflationary forces as we've seen it throughout the years. And that is the true limitation of monetary policies being so extreme, in my opinion. So they're trapped. They have no way to get out of this. And so they're going to have to continue to inflate the economy. And in my opinion, this vicious cycle of where we create inflationary forces and then the Federal Reserve has to act on it, perhaps tapering or trying to normalize their policies. And then we see a financial shock, usually, which is kind of what we saw back in 2018, 2015. Those shocks are then immediately accompanied by large amounts of monetary and fiscal stimulus. And that all feeds on what I think it is a long-term inflationary problem. And so at some point, and I think the inflation gene is out of the bottle, and it's going to be very difficult to stop that from developing, because once consumers and corporations start to behave accordingly, it's difficult to change that mindset. So I think we've triggered that, in my opinion. And the way to expose yourself towards, if you believe in that, is to buy tangible assets. And there's a lot of forms. And I think commodities will play a very large role in markets in the following years.
Mm-hmm. So, Tavi, what is the argument against inflation? There's some that point to more of a deflationary scenario coming instead. So why do you not see this as being a likely scenario?
Well, I do, and I position myself accordingly. I think the core, it's a very good question. You have to see the scenario in the probability terms. I would say that when you see the path of least resistance for the Federal Reserve today is to continue to inflate the economy. What is the second one? Well, the second one is to normalize policies, try to reduce the inflationary forces in the system, and that will create a financial shock. If you believe that that's what the Fed is going to do, you should be short stocks. You should be, I think you should have a lot of hedges in your portfolio for risky assets as a whole. We have it in our portfolio. I think that how do you fit yourself into the two scenarios here? Now, I think they're going to pick the inflationary route. That's the way. I don't think there's much of an argument of where they should be going here. I mean, they've been mocked for many folks, given the fact that they have hiked late in the cycle in the last 2 or 3 downturns in the economy, as most people know. I think that they are very much aware of that. And I think they're going to take the opposite route this time around, where they will try to do something. And immediately, if they see it's creating some sort of financial conditioning, tightening as a whole in the economy, I think they're going to reverse those policies very quickly. And it's quite interesting as far as the market behavior so far, especially when they started talking about tapering, is that, well, first of all, they were still buying very, very large amounts of QE while they were talking about tapering, meaning they're increasing their purchases of treasuries. And that obviously had an impact suppressing those rates during those talks. You would expect that rates could be going higher as they talk about tapering, but they are the ones actually suppressing those rates at that time. Now that we're starting to see rates beginning to move on the upside, and that's the real risk for the Federal Reserve. They're never going to admit to that, but that's the real policy. When you break down what the mandate of the Federal Reserve is today, it has nothing to do with employment and inflation. It has everything to do with suppression of rates. So what are the deflationary issues that we have in the system? Well, money velocity is a major one. And, we've been in a secular decline on that. We've had that happening in Japan for a real long time. A lot of people like to look at Japan as a model for the US, in Europe. And I think it's a great example of the issues we're seeing, where a lot of the units of growth, we're using more units of money supply in order to create less units of growth in the economy. And that certainly is more of a deflationary impact in the economy. We have the technological advancements that have been a huge part of that. I think that have positively impacted the economy in a way of disinflating prices of consumers and in general. And I think that has played a major role in this. The other one is demographics. The aging demographics is a huge part of this as well. But a lot of this, when you go back in history of demographics, we saw that in the 1910s as a reason for why we wouldn't see inflation. And that did not play out well. There's a lot of folks that said that the technological, it's very similar actually. If you read books about the 1910s, I know it's a long time ago, but if you find books about that era, you will see that the issues with when it comes to the arguments for deflation at the time are also really strong. There are folks talking about this, the technological advancements, very similar argument to today. The demographics was another one. And so I don't think that that's necessarily, there's those single factors that have worked throughout history, but have also failed throughout history. That's what I'm trying to say. What I like about the optionality of how do you expose yourself in this environment is the commodities to equity ratio. You buy commodities, tangible assets, to really create if you believe that we're going to see inflation. So that's the core of the exposure in our portfolio. And then we build hedges aside with on the equity side of companies that have high multiples. So the commodities to equity ratio, in my opinion, will rise in this next few years or next years or so. And those are long-term trends. We've seen Commodities performed very well during the 1910s, during the 1940s, 1970s. And I think we're entering another one today. Sure, we've had a big run recently, and some of those are going to consolidate. Some others will continue to rise. But I think it's time to build a position in that part of the market, as we're going to see a lot of natural resource companies taking control of the leadership in the market going forward.
Tavi, I'd like to go back to something that you mentioned here is the monetary velocity and wages. So how do both of those things fit into this inflationary narrative, together to be able to create and push prices higher?
Look, the money velocity issue is definitely a counter argument to what I think it's going to happen. And in my opinion, we're going to see a shift on that as well at some point, where at least a stabilization of that ratio will allow inflationary forces to creep up in the system. Wages and salaries is a major, I would say, a change here when it comes to this macro environment that we're in. We have not seen, if you look at the increase in minimum wages on the federal level, we haven't seen anything like that since 2009. I think has been a lot of issues of bringing folks back to the labor force. Clearly, folks are looking to be paid more. And so, with job openings rising and the need for companies to hire those folks, I think we're going to see a very large increase in wages and salaries to attract those guys to get back to work. And so I'm very focused on this because I think it's going to create a squeezing margins of a lot of companies. And obviously that will also create a lot of inflationary issues. Some of those are going to be passed on to consumers, and some others, companies are going to have issues. It will depend on the business model of a company and their way of having power into passing on to consumers or not. So we are, as a fund, very focused, looking for those that will find themselves into a corner here, having to raise wages and salaries, and unfortunately not be able to, unfortunately for those businesses to not be able to pass it on to the consumer. So they're going to be squeezing their margins in a large way. And this will create a change in prioritization of security selection as a whole, where we've seen the last few years a very large focus towards top line growth and revenues and increasing revenues as a whole. But now I think we're going to see a bottom line improvement becoming more and more something investors are paying attention to. We've had fundamental analysis becoming out of favor. I think that's going to come back here soon. And so I've been very, I've been looking at a lot of the companies that could perhaps become the new darlings of the market, and some others that may become issues here. And I think the natural resources, the more I think about this and the more I look at the profile of those businesses within this environment, I really think that we're seeing some large improvements in bottom line of commodities overall. And so I think that those are going to become more of the leaders of the market in the next few years. Regardless if it is base metals, precious metals, or energy. We've had energy taking control of the market in the beginning of the year. I kind of lost a little bit at the middle part here, but it still is very different than what we saw in the last 10 years. I mean, when do we see energy taking control of the market this way? So it's those are changes that perhaps not a lot of people are paying attention to, or thinking that those are more cyclical, short-term cyclical rather than long-term trends. And I'm on the other side of that. I really think that that's about to change. But wages and salaries are very important to look at. This was something that happened in the 1970s that I think was what really built up on inflation at the time, and why we saw higher highs and higher lows on CPI number, which is probably not the best way to be calculating what the real inflation in the system was. But since we have that data, why not look at it? You can see that inflation was cyclical, but also built on itself over time until it peaked in the 1980s or end of 70s. And so I think that we're kind of getting into that setup rather than the 40s, where the 40s We saw sporadic increases that still took another, 2 years, 3 years to stay at very sustainably high levels, or above 5% or so of CPI growth. And so I think wages and salaries is one of the, and you have to mix the, really look at the two reasons for why we saw inflation in the 40s, 70s, and the 1910s. Those are the inflationary, perhaps decades you can find, much more the 10s and the 70s. And you can see that there's a lot of similarities with that in today's environment, but a lot of differences too. So it's almost like you're mixing the worst parts of the 1970s and 40s and 1910s into one scenario that is what we are today. And I'm referring to issues with amount of debt that limits the central banks from tapering, from allowing cost of capital to rise. And some may say, well, in the 40s, we've had this kind of financial repression as well. It's true. But the issues is that the tax policies are different. The valuation of risky assets were different. And so all those are big differences. And when it comes to even, where the gold standard was, we didn't see, gold was pegged at that time and not today. Today we're seeing this endless, willingness of central banks to print money as a whole. And some folks don't like to use the word print, but that's clearly what we're seeing right now. Long way to answer your question, Tom. Sorry to go on and on, but I think wages and salaries is a structural change in inflation, and will prove to be, in my opinion, what really changes the picture of what we may see in the next decade or so.
Mm-hmm. Tavi, just to cover, let's say, all our bases, how does gold perform in both an inflationary and a deflationary environment? And maybe, highlight for us, if you will, what are the differences in each?
It's a good question, and one that it's why I like gold and silver so much, is the optionality behind it. You can see gold working very well in the deflationary environments. Let's use Japan as an example, as everyone likes to look at Japan. You look at the secular decline of money velocity in Japan, and you chart gold in Japanese yen terms. And you can see clearly that there is a major divergence between the two, where gold in local currency terms has been rising while money velocity has been in a secular decline. So, and we all know what's happening in regards to aging in Japan as well. So deflationary forces did not prevent gold prices from rising. That's the one important takeaway. The other thing that you may see with gold is a lot of folks try to connect gold with inflation. I really think that the bigger correlation of gold has to do with monetary and fiscal disorder. If you are a believer that we'll continue to see the Federal Reserve and policymakers as a whole continue to provide fiscal and monetary stimulus to allow, to force the economy to grow. In other words, if the economy continues to be dependent on those policies, I think that that's what creates a bull market for gold. We've seen that in Japan over the years. We've seen in the 70s when we took the disciplinary seatbelt off back in the early 70s when we broke the gold standard. Those are all signs of why gold and silver and why investors began to really buy into those assets. The other thing that is happening in a large way, which perhaps is the biggest reason for you to own gold nowadays, is that everything yields more than inflation. You don't want to own tangible assets that don't yield anything usually. Now, when you're in an environment where there's a difficulty from investors to find yield, where inflation expectations is yielding more than the S&P 500 earnings yield, the free cash flow growth for most sectors. I mean, if you look at sectors as a whole in the S&P 500 today, every single one of them is yielding less than CPI. And we all know CPI is highly understated. So I think that that's what forces capital allocators to look for tangible assets as a form of protection of capital. And this is, if there's one time you want to own, why do you think in 1910s and 1940s and 1970s, commodities did so well? Sure, they're all different times. In the 70s, you had gold, and especially I would say the Federal Reserve being able to act in a way where it could basically track inflation. If inflationary forces are rising, they're able to raise rates. So monetary policy was very volatile. In the 40s, they couldn't do that, so they have to keep, that repression in financial conditions as a whole. All those are very positive for commodities in general. So I think that gold, it will serve a very important role here. And unfortunately, a lot of people are seeing the very interesting developments in crypto markets and saying this is the end of the gold market. I think this is the perfect storm for gold. And when it comes to the level of sentiment just being so negative, we're seeing the miners making a significant amount of money in this environment right now. It doesn't matter if gold goes up, 5 or down 10% right now. I mean, miners are really becoming very profitable businesses at these levels of metal prices. We haven't seen this throughout history to the same degree we're seeing today in regards to margins and the way that they're reacting towards this. And the other thing, Tom, that has to do with gold is the supply side. We all know we haven't seen any supply, new gold discoveries in the last 3 years or so. Perhaps newfound gold is going to be one of them here in North America. But it's still, when you look at that throughout history, I mean, we're really, it's been very challenging to find gold. And so I think that's all playing a very important role into why capital allocators will at some point start really buying gold. And central banks are another part of this, where the quality of international reserves will become something we may see where they're going to be forced to buy into high quality assets. And I think gold is going to play that role as well of serving those international reserves to become with higher quality. And I'm talking about Brazil, Turkey, China, even the US and Europe and so forth.
So, Tavi, what in your view has been the biggest headwind for gold over the past year? Is it that we haven't really sparked the fear trade yet with a broader market crash?
It's a good question. I think real rates have slightly caused some issues in the very last months or so. We've seen a divergence recently. I don't want to say that we haven't seen a divergence, but I would say since August, we saw some issues there. I think that has a lot to do with gold in 2018, from August of 2018 to August of 2020. So basically 2 years went on a roll here and was up about 75%. We all know gold doesn't move that much. So that's a very large move for gold. And what was his signaling ahead of any other asset in the tangible asset world? It was signaling what the Federal Reserve was going to do. But then markets are always looking ahead, and people are always looking at the changes in the markets and trying to make sense of that in the present. And that's the wrong way to do it. And so gold was signaling that a lot of disorder was coming our way. And that's exactly what we saw. And back in August of 2020 was kind of when gold sort of peaked, and we saw this major consolidation mode. And since then, we've been on this talk of the Federal Reserve doing less, the fiscal stimulus doing perhaps less of what they did at the beginning of the pandemic. And so all of that is pointing to what has been hurting gold, in my opinion. The question to investors that want to look ahead is, do you believe the Federal Reserve can sustainably taper going forward? I think the answer for that, in my opinion, is no. There's one very interesting chart as well, Tom, that not a lot of people are looking at, but is the euro-dollar curve. So you look at the euro-dollar of next few quarters relative to the euro-dollar contract of 2 years from now. So you can kind of see where the market's pricing in the risk of rate increase in the following years. And that indicator itself, actually, so the euro-dollar curve has been following gold prices very closely recently, and which says if you think the Federal Reserve will be raising rates in the future, you believe that you shouldn't be buying gold. And so, again, I want to go back to the optionality of gold, because gold has worked well during times when rates are rising. 1970s is a great example of that. But I kind of think that right now it's there's a true limitation from policymakers on preventing financial collapse as a whole, given the valuations we are. And so I think that that would be an even larger constraint, is to normalize their policies. And so as we go and move towards that, I think policymakers will find themselves trapped and have to back away from those ideas of normalizing rates and perhaps tapering and so forth. And as we see that going forward, I think that the back away process of that is what leads to the next bull market in gold. And the more investors begin to realize that that's going to be the case, that's when gold is going to start moving here out of what I view as a consolidation mode. So that's what I'm focused on mostly is when does investors really realize that the Fed is really trapped? And once they do, and they know that there's going to be some sort of either, you can call it yield curve control, you can call it a return to QE, you can call it a longer period of time with rates at zero. I think that's when gold is going to be doing even better. And we're in a part of the scenario or the cycle right now where the Fed is trapped and is looking for an exit. And right now they do have an exit. They're going to take it, which is they had good numbers recently in the economy. And so they might be looking at this as a way of exiting their policies. Now, the market is not going to like that, in my opinion. And at some point, we're going to see an issue where financial, conditions are going to tighten, and markets are not going to like that. I don't know when, but and that reversal of policy is what's, in my opinion, going to create a large inflow towards gold and precious metals as a whole. And I think we're going to see the second lag of this since 2018, 75% up, consolidation. I think we're going to see a second lag in the next year or so.
So, Tavi, out of all the metals, I know you follow gold, silver, and platinum very closely. So, are there great opportunities in all of these metals at the moment, or what role does each one of them play in the portfolio for you guys?
Oh, it plays a major role. I think looking for silver exposure has been one of the biggest goals of Crescat. It's been very difficult to find, a primary silver deposit worldwide, and I think we've had a few very good positions in companies where we've been funding a lot of deals in the exploration space. We've got over 90 plus deals that we've invested in. We really think that there is first of all, there's, with the major companies becoming more and more profitable, I think what we're going to see is this liquidity floodgate of fundamentals improving that creates the need for new exploration projects. And so very few folks are focused on exploration right now. And I think that's what creates a large demand for those projects. Going back to silver and gold, I think those all monetary metals are kind of fit into right in between, not only the capital protection argument, the need for fiscal and monetary discipline, and more people, some of them like to create that exposure with crypto. I like to think that gold and silver, precious metals as a whole, seem to be the most contrarian way of making that play today, given the sentiment. I think you go out on the streets, a lot of people would agree with you that you should be buying Bitcoin. And so I don't see the same level of agreement on precious metals. What I like about silver as well is there's also the other side of it, which is the green revolution, which I think is a real push we're seeing, almost like bipartisan, really. Not so much as the China front of the fiscal agenda, but there's definitely a push towards electrification and solar panels and so forth. I think we're going to see a large increase of demand for copper and silver in regards to that. Those, people look at that with the lenses of short-term lenses. Those are long-term plays. I mean, it takes a while to create that type of demand that a lot of investors are talking about, but prices are always ahead of that time. So I think we should be, and being involved with exploration, I know it's very difficult to find those metals. And silver fits right in between it. It fits in that green agenda side, but also on the monetary metal side. And it tends to do very well, even especially during long-term inflationary periods. And so I think we're entering one, and that's why I like silver quite a lot as a much more of asymmetric opportunity here. It's the metal that I like the most. I think it's the cheapest metal on earth. I think we're going to laugh about in a few years that some folks were able to buy silver below $30 an ounce. I think this is really a gift. But the way I do it is I've been buying silver. I've been buying not only silver itself, but silver in the ground, and which is probably the most levered way of making that play without not leverage in the sense of debt, but in the sense of the price. And so high quality silver projects is not easy to find, but it's been a very large focus of Crescat. Platinum is also an interesting play. It's even harder to find those pure deposits on that look attractive for us. Gold has been, it's a little bit. I'm not saying it's easy at all, but it's easier to find primary gold deposits, and so you can find easier exposure to that. But it's hard to find high quality ones. So I think there's a lot of ways to play this. I mean, some investors, as they become constructive in gold, silver, precious metals as a whole, they start looking at the large, companies that are involved with that, Newmonts and Barricks and Kirklands of the world. And you can look at the royalties, and you're getting paid for the risk you're taking. That's about it. You're taking the royalties. Your opportunity might not be as asymmetric as buying Newmont and Kirkland and so forth. And then you go down to the developers. There's obviously a risk of developing those mines, and there's a lot of, as I said before, there's a lot of financially savvy and really smart guys, exposing themselves into that market. And then there's the geologist side, which is really the exploration part of the industry that I think it's even more compelling as far as a thesis for investing. So long way to answer your question again, but very, very focused on gold and silver and precious metals as a whole.
Excellent, Tavi. So as you pay attention to many markets, if we think about some of the biggest bubbles around the world, how much risk do you see the Chinese stock market correction as having on the rest of the world's markets? I saw an article even last night that trading on some bonds had to be stopped because of their precipitous fall. So how does this Chinese situation play out to you?
It's the largest deflationary risk in the economy today is China. And a lot of people are not seeing that way. And the risk is really on the currency side, in my opinion. It's the equity market that falls and creates, I think China, first of all, is a credit bubble. Some people say the US has a lot of debt. No disagreements there. Obviously, this US has debt all the way to their neck, from the corporate side, from households, from especially the government side. But so is China. And you look at China being a closed capital account economy with the levels of banking assets they have, $52 trillion of banking assets on balance sheet. What about the off balance sheet stuff? So, that is 314% of GDP today, way higher than I don't remember seeing any large economy having such an enormous banking system relative to their size of their GDP. And so I think that clearly we have some issues in China, but a lot of people are seeing this as an opportunity, given the sell-off recently and the divergence between Chinese stocks relative to U.S. equities. I think it's a little dangerous to play that game. I think the divergence is actually has a lot of meaning. It has, in my opinion, is the largest divergence, even worse than what we saw in 2015. And we're seeing issues in a lot of fronts. I mean, just look at the required reserve ratio for banks have been declining. That follows the Chinese yuan closely too, which suggests that yuan or the PBOC would be acting on something here in order to ease up a little bit of the currency. In other words, devaluing the currency. And it's pretty easy to see if we see 20% devaluation in the yuan, that would be seen as deflationary, not inflationary. We're still in a period where China is the manufacturing plant of the world. and that would have a lot of meaning in regards to the impact of that in the world economy as a whole. I think that the major Chinese banks, when you look at them, there's Industrial and Commercial Bank of China, which is down about 40% since February 2018. 40%. That's a 5.2 trillion asset bank, twice the size of JP Morgan. So I think that there's clearly an issue with a lot of those businesses. Obviously, has to do with parts of it has to do with the crackdown of the economy in regards to the CCP on domestic companies. It has to do with some ADRs having issues in the US. In other words, Chinese companies that trade in the US having issues. And so there's a lot of problems where you can see this coming from. But there's another one that I'm not sure a lot of people are focused on, which it has to do with inflation. China has a lot of debt and has a lot of banking assets, as I said before, which usually is a precondition for a credit bubble. And when you look at this issue, one thing that I've always been worried about is what if there is inflation and cost of capital rises? That's usually what pops those credit bubbles in a large way. The U.S. has been able to sustain the levels of debt that we've had in a long time, and that's because of being the reserve currency for so many years. China doesn't have that. And so what we're seeing right now is inflation getting out of control in a lot of places. And I think the policies in China are very different than the policies we're seeing elsewhere, where China is really, really trying to fight inflation in a very significant way. In fact, it starts from underreporting. Look at the CPI numbers being below 2% in China. And you look at the import prices year over year from the US, meaning most of the import goods and services come from China, up about 16, 15% or so year over year. What's the difference here? What's going on? Are they massively underreporting that as well as inflation? We know the US is. And so I think those policies against inflation as a whole is beginning to have an impact in the Chinese economy. So we're seeing major slowdowns. If you look at the Chinese equities year over year change, it clearly tends to lead a move in ISM manufacturing here in the US. In other words, the growth in economy in the US is highly linked to the growth in Chinese stocks. And so people are seeing this as an isolated problem where China is having issues in their own domestic world, when actually I think it has a lot more implications to the rest of the global economy. And so I think we're starting to see some issues here. And the way I view this as a portfolio position is to have some put options in the Chinese currency. It just adds another layer of asymmetry. I think it creates one insurance possibility. Why not have that? And if I'm wrong, I'm only risking 1% and 2% of the portfolio. If I'm right, it could really save the portfolio given the fact that our core investments are on inflation. So I think for any portfolio managers, you always should be looking to, you find your core position, but then you have to look for what are the risks towards your thesis, and the risk to what I was talking about, which is the pillars of inflation and the sustainable growth of inflation in the following decades, and how tangible assets can perform well. Well, what is the risk for all this? Well, first of all, one of them is organic growth. I don't believe in that. The second one is a deflationary shock in the system caused by an exogenous force, and that, in my opinion, is China. So we are currently hedged towards the Chinese currency. We've been hedged for a long time. We've had very great years in 2014, 15, and we've had bad years in 2020, for instance. And bad years means losing the insurance. 1% to 2% of your portfolio is worth zero. And so it's really not the end of the world. If you get the other sides of your portfolio right, I mean, if I'm wrong about this deflationary risk, that means I would think that tangible assets would perform very well. And so I really like that as a spread trade as well. And it's not only owning tangible assets in dollars, but owning tangible assets relative to the most overvalued currencies in the world. So I think China is a very big problem for the rest of the economy globally.
So, Tavi, exactly in that vein, as you're saying, it's a big problem for the rest of the global economy. Can you spell that out a bit more for us? Like how does that start to affect the rest of the world? And lay us out some reasons on why you see that.
Well, let's start with the China being the engine growth of the economy, global economy. It's been certainly a large, significant growth generator for the global economy as a whole. And so we've had, if you can just, again, if you chart the Chinese equities relative to a lot of macro data, you can see there's a clear relationship between those numbers. And so it makes a lot of sense. I think that the Chinese economic model has grown in a way where exports have been, importing raw materials to then export final products has been one of the really big economic models for China. And something that's been broken recently is the fact that raw material prices have been rising significantly. And so that has been an issue for China, in my opinion. China has a lot of problems in regards to the real estate market. The large amounts of, it's an economy that has full control over, there's no doubt that they have full control over their economy when it comes to political leadership. But we've seen throughout history is that those uprises from the population and especially the bottom 50% of those economies beginning to have issues and demanding higher wages and salaries are things that usually leads to instability. And that usually leads to those parties, those political parties to find a nationalist form of dealing with the issue, meaning looking for a war, looking for taking over Taiwan, taking over Hong Kong, things like that, which is kind of what we're seeing right now. So, look, I think that the issue with China is a very similar issue that we've seen throughout history when it comes to the growth of any economy that grows too much when it comes to the credit side. I mean, it's not normal to see these levels of credit relative to GDP. Everyone is looking at the growth in nominal terms while not looking at how much levels of debt, units of debt were had to be created in order to create, 10% of GDP growth. And it's almost, what we are, it's 300% of banking assets to GDP. It's extreme. Look at the M2 money supply, for instance, in China, which is today about $36 trillion versus in the US, which is only $21 trillion. We all know that the US has a larger GDP relative to China. So why does China have such a large amount of M2? And that credit growth is what creates the problem, in my opinion. At some point, you reach a limit of that. And perhaps we're peaking, the credit cycle in China has peaked, in my opinion. And so I think that that's going to have a lot of ramifications when it comes to, for those who believe. So if you believe that the China is peaking on the credit cycle, how do you reconcile the fact that the Federal Reserve is trying to normalize policies? I think that's one of the misconceptions in the markets today. And I think that's another reason for investors to be looking for protection towards the reversal of policies here. This is nothing. This is something that the Federal Reserve doesn't have a lot of control on. Now, if China really is having a financial shock, which is a large percentage of folks don't believe in that. They believe that it's only a domestic issue and it's kind of an independent problem created by their own government. And I don't think that that's the case at all. I think we've seen some of those independent issues in 2015, 16 with the conglomerates of large companies in China that had issues with the government as well. So this is not something new. However, I do think that the implications of this are being much bigger than we saw. Look at the PMI numbers and actually the non-manufacturing numbers that came out last week. It's the worst levels we've seen. It's actually below what we saw in regards to economic activity than we saw in the global financial crisis. there's something brewing in China no one is paying attention to. That's not the case in the U.S. The U.S. is still, it was overheated in the first part of the year and now has been slowing down significantly in growth. But it's still growing fast relative to China. So which one's telling the truth here? I think that China is a real problem. We've had we had to increase some of our exposure there. I mean, it's astonishing to me that the Chinese currency has actually gone the other way recently, which tells me that there is a much larger level of control from the government to not allow that to happen. So I think it's just an asymmetric bet, and it will have a lot of impact globally. And I think it's a true contrarian trade. I mean, I really think that most of your listeners are probably listening to this and saying that no way that's going to happen. We haven't seen that happen in the past. The U.S. is the problem. And it's all a relative game. I mean, we've seen, obviously, the U.S., when you look at fundamentally here, in regards to the amount of debt and the growth and issues and macro imbalances that we've had in the U.S. over the years are also very concerning. And that they've been masked by the levels of stimulus created by policymakers. And, I think that the issues in China are no different, perhaps a lot worse. And so, and I can prove that just looking at the numbers. And so I think that that's something that concerns me quite a lot. I think the global economy, a lot of policies of normalization are not linked to what's really happening in China. And I think that may become the story in the following months here. If I'm right and no manufacturing PMIs, stay down and continue to go lower in China, what does it mean for the Federal Reserve here? Are they doing the right policies, trying to taper right now? What if they have to reverse and because of that, of those consequences in the Chinese economy? That's all very possible, in my opinion here. So it's positive for tangible assets, positive for gold and silver, but also very negative for equity markets. So I like the commodities to equity ratio right here as a possibility of playing this setup.
Excellent, Tavi. Well, we covered a lot of ground here on this interview today. Is there anything else you'd like to mention before we wrap up?
No, I think it's important to step back when you have those issues with prices as a whole, especially precious metals, given the consolidation. I would suggest a lot of people that have become skeptics about gold and silver recently, given the fact that it has not worked, while a lot of cyclical commodities and crypto assets have gained momentum. Step back, look at the charts on a quarterly basis, and you'll see that gold has been trading in this range for a long time. And I think that once we gain momentum here, and the trigger could be what I said, the reversal of policies. The trigger could be further fiscal stimulus through one of those agendas that I said before. All those things are going to create a large demand for an asset that has played a major role in the monetary system to protect capital against inflation and monetary dilution. And I think that that's not about to change. That's about to stay in regards to how central banks are going to continue to look for high quality assets to improve their international reserves. And so pay attention to the long-term trends in gold and silver. Silver has a very, very big resistance in the $26 an ounce, believe it or not. Look at the quarterly chart, draw your line from 2011. You will see what I'm talking about. And once we break that level, I think we're going to speed up and move in an explosive manner all the way up to the $50 an ounce or so. And I think gold is in the same setup. It has broken out to new highs. It stayed in that range that it was back in 2011. If you look at the quarterly chart, we're right in that range that we saw in 2011. It's been consolidating in that range for a while, and I think we're about to have another major move for precious metals as a whole. And investors like to buy the breakouts. I like to buy the dips. Once I find a secular identify inside of my macro views and process that we are in my opinion, in a secular bull market for precious metals, I'm a buyer of every dip if I can. So I think that's an opportunity for a lot of folks. And I view this as an opportunity for my clients and for myself. And so very focused on this as a money manager.
Excellent, Tavi. And of course, you have an excellent Twitter feed with tons and tons of charts. Your charts are literally shared all over the Twitter sphere. That's at Tavi Costa and also Crescat.net. Anywhere else you'd like to point to?
No, that's it. I might have an Instagram at Tavi Costa Macro is another place. But yeah, everything you said it very well. Thanks for sharing that, Tom.
Excellent, Tavi. Thank you for your time today.
Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.